Hello, chart watchers, and welcome to this Thursday, March 22nd Market Watchers Live show with your hosts, Tom Bowley and Aaron Swinland. Today, we got another great show for you. For those of you joining us for the first time today, we're certainly glad to have you. And for our regulars, a welcome back. All right, let's take a look at what is going on today. And I tell you what, this is a very interesting day because we are seeing a lot of negative action. I think in the next 30 minutes or so, we're going to have President Trump outlining some tariffs against China. That has the market very, very nervous. So let's take a look at this point, what's going on so far. We have some pretty wild action taking place. You can see here, we have the Dow Jones Industrial Average right now down almost 500 points, 474 points today. The S&P 500 down 46. The NASDAQ down 134 points. Russell 2000, actually on a relative basis, hanging in there, if you can imagine that, being down 20 points. But it is down 20 to 1560. The 10-year Treasury yield went down and touched the bottom of this range that we've been watching at 280 after yesterday afternoon, almost touching the top of the range that we've been watching here over the last 5 weeks or so, up at 2.95%. Volatility index, this one is worth watching. We are back up at the 22 level. This is where we kind of topped out in early March with the weakness that we saw in the market. So whether or not we can break above this 22 level on the close, I think will tell us a lot about where we might be heading near term. The XLF really struggling with rates down. The XLF you can see down 2.61% today. Banks taking it on the chin, looking like they are heading back for that early February low. Asset managers following suit to the downside. Of course, with the yields falling the way they are, that is helping utilities. Their dividend yields look much more attractive when we see big drops in the Treasury yield. And as a result, the XLU is up. And I believe this is the only sector that is up today. Facebook, continuing to watch Facebook. We did break below 170, which I think was big support break. Yesterday, we got back above 170 on an intraday basis, couldn't hold it. And now we're back down again today, down another $4 on Facebook. So a lot to talk about today. But first, let me bring in my co-host, Aaron. How are you doing this morning, Aaron?
I'm doing just great. The Ducks are finally doing well. We're going to maybe make the playoffs, so I can actually bring them up right now.
Yeah, I can always tell how they're doing based on whether or not we have a hockey discussion.
Talk about it. Well, last night I really feel bad because the Ducks pretty much took out Greg Schnell's Calgary Flames out of the running. So we're their nemesis, and we continue to be. And I'm very excited. We're in third, but gosh, it's just a tight race. And don't tell me that everyone makes the playoffs, because they don't.
No, they don't. And we always make the playoffs. I'm talking about the Washington Caps because we are the best regular season team in history. We just can't win anything in the playoffs when it really matters.
Exactly. Right.
But anyhow, I know you don't feel too bad about eliminating Schnell's Flames. I've heard this rivalry going back and forth. And I know there for a while, I mean, I'm not a huge hockey fan. I'm interested, especially when it comes playoff time. But I do know that there was quite a streak where your Ducks had beaten the Flames in Anaheim some ridiculous amount of times in a row, like 30 times in a row. Is that streak
31.
still on?
31. No, they actually broke the streak this year with a win, I think, earlier in the year. We were all bummed because we really loved yelling, "You can't win here."
Well, I'll tell you what, I know one place we can't win today, and that's on Wall Street.
Not a good day.
We got a lot to go over, and we got another new interesting segment that we'll talk about in a few minutes. But I'm going to let Aaron, I'm going to let you take it away and go through our announcements and agenda. We'll get started.
Yes, and the weekly schedule, we've filled it up so you can see what's going on next week. We also have Friday, tomorrow. Tom, you're going to be doing your workshop on reasons to sell. I know everybody is very excited about that. We have everything stock charts on Tuesday, and I think Grayson will be in for that, but we'll have more data on that next week. Mark Young from Wall Street Sentiment, he came in, back before Thanksgiving, and he is back to talk sentiment with us. I'm very excited to have him back on the show. And then we have on Thursday, following, Arthur Hill, our very own, will be here to give you his outlook on the markets. So that'll be next Thursday. I do happen to know next Friday, the market's closed. So we'll have a little bit of a break. But for today, we're going to start with a new segment called The Big Picture, and we'll talk about that a little more as when we get into it. But I think you're going to all like it, especially those intermediate term traders. We have a scooter report for you. Following that is the 10 and 10 to 1. And our first symbol will be Deere and Company, DE. So we'll take a peek at that one. And then finally, we're going to have an agree or disagree. And if you are here live, and actually, if you're watching this within one day, the poll is up and you'll see the question there, and you can tell us if you agree or disagree. But for those of you who don't have the poll, I'm sorry, I'm just going to leave it at that. You'll get to be surprised. So with that, I'm going to pass it back to you, Tom, for some technical news. And yes, there's a lot of news out there.
Yeah, it's a big day in the market. We'll see how we finish today, because I always like to see how the market finishes at the end of the day and whether or not we can see a rally or not. But here's a 5-day, 10-minute chart of the 10-year Treasury yield. And I wanted to point this out because I want you to see the volatility at 2 o'clock yesterday when the FOMC policy statement was released. It was Fed Chairman Jerome Powell's first Fed meeting, and he did raise rates. Well, the Fed raised rates. And they talked about 2 more this year. And they actually talked about maybe even hiking 1 more than anticipated over the next year or 2. So it was a little bit more hawkish, I would say, based on that. They also raised the GDP forecast. They're looking at further economic strength ahead, that things look like they're really starting to pick up. So as a result, you can see the bond market was pretty confused, as was the stock market. We had huge moves back and forth right after the announcement. Some worried about the higher interest rates, but then others excited about the prospects of more growth. And so it's that battle that's taking place. You can see that after the announcement, the 10-year Treasury yield jumped up to almost 2.94%. Of course, 2.95 was a recent high. I still think at some point, probably in the next several weeks, we will be challenging that 3.05% level, which dates back a few years, I think maybe 4 years. I think it may have been in 2014 that we hit 3.05 or in that neighborhood. So I think eventually we'll head back in that direction. But in the near term, volatility remains. So after hitting almost 294 yesterday, you can see the 10-year Treasury yield today went down to 280. We did get a few economic reports out. Of course, it's Thursday, so we had initial jobless claims out at 8:30 this morning. 229,000 was the actual number. The market was expecting 225,000, so a little bit higher than expected. Then the January FHFA house price index came in, and for the second straight day, housing got some good news. This index went up 0.8% in January. The market was only expecting it to go up 0.4%. So a couple of pieces of good housing news, and as a result, housing is down today. Home construction is down, but it is down less than the overall market. It's actually one of the better relative performers. March PMI composite flash, 54.3, market expecting 55.2, so a little disappointment there. And then finally at 10 a.m., February leading indicators came out, and there was a rise of 0.6%, market expecting only 0.3%. So a mixed picture, but clearly the market was just focusing on safety at the open today. And I think a lot of this is due to the uncertainty of what's going on with the tariffs, how China may decide to retaliate. I think it's pretty clear Wall Street doesn't want a trade war. And so it's that fear of the unknown that I think is really driving the market right now. That's why we've got the volatility rising. That's why we have a lot of money moving into treasuries. Anytime you see the treasury yield moving down, it's as a result of buying in treasuries. Treasury prices and treasury yields always move inversely, always. So anytime you get the yield down, it means money's going into treasuries, and that is defensive. There are a number of different ways we can look at the market being defensive today, and this is just one of them. I'll show you others in just a minute. The Fed policy statement, though, yesterday they raised funds rate 25 basis points as expected. That will have an immediate effect on many consumer loans like credit cards and so forth. If you're looking at mortgage rates, that's tied much more toward the 10-year Treasury yield than it is the very short-term funds rate. Let's take a look at the volatility index, because this, I think, is really critical when you get into these periods of selling. And if we break out, I think if we close above this 22.5 level, that could spook the market. So this is a level that I would really be watching closely today into this afternoon. If we have another bout of selling this afternoon and the losses start to mount and the VIX breaks above 22.5, we could potentially open pretty ugly tomorrow morning. And so I would take some necessary precautions there. That might mean selling some of your positions, all of your positions, might just mean put insurance. Of course, the problem is when the VIX starts rising, the puts become much more expensive. So you got to consider all of those options. But it's never good to see the VIX on the rise. I mean, when we get the huge drops like we saw in the beginning of February, this is what happens. The volatility starts getting out of control. The market gets very fearful. And I refer to it as market makers going on vacation, because they are not there to provide liquidity. Everyone's selling and there's no buyers. And that's why we see these sudden, swift drops, 1,000 points on the Dow. When we're in a good market and market makers are willing to buy, it's rare, in a complacent market where we see the Dow drop more than, 50 points at a time. But again, you get into a fearful market and we can see some very, very strong periods of selling. And so let's keep an eye on that as we move toward the close. A couple of stocks that came out with earnings today and yesterday after the close. CCL, this is a consumer discretionary company that beat on the top line, $4.23 billion in revenues versus $4.11. They beat on the bottom line, 52 cents versus 43 cents. They raised guidance, and what happened? Well, we're flat today. See, that's what happens, unfortunately, when you report great results on a day like today. The stock had gapped up. It actually got up as high as 69, but it is now back to 67.06, exactly where it closed yesterday. So I'm not really liking this action in the short term, but I did like that earnings report on CCL. GES, another company that is in that consumer discretionary space, and you can see quite a reaction here. $792.2 million in revenues, market only expecting $750.6 million. So a huge beat there, probably at about maybe a 5 or 6% beat on the top line. Bottom line, 62 cents versus 53 cents. And we are getting a huge move higher here with very heavy volume and a breakout. And if we take a look at a weekly chart, because we had a lot of sideways action there, you can see that we actually started an uptrend back in May of last year. Sideways consolidate. We had a negative divergence on the PPO, higher prices, lower PPO, went all the way back down, hit that 50 period moving average, nearly tested centerline support. I consider that a reset, and now we're back off to the races again. I think GES looks really good on its chart, but it's right on the heels of earnings. I don't like chasing, so it's one that I'll be adding, I'm sure, to my strong earnings chart list and wait for potential entry somewhere down the road. But again, on the daily chart, if you look at it, right now we're getting a pretty key breakout. If we come back down and fail to hold the breakout over, say, 1940, I think that opens us up maybe even to move back down toward the open of today, which was 1777. And that's where things could get much more interesting for me as a short-term trader. I mentioned that there are multiple ways that you can see how the market is turning defensive. I want to pull up the sector summary here first. And you can see, number one, utilities are leading. Consumer staples actually has also moved to the upside. So we do have two sectors that are green today, but they're both defensive groups. So I think this is a pretty clear illustration that defense is where, defensive areas of the market is where the money is rotating toward. Financials, technology, and industrials, 3 of the 4 aggressive groups on the bottom, trailing all the other sectors. So this is definitely a bearish kind of a day. Very difficult to sugarcoat what's going on here. If you pull up financials, though, check out what's leading in the financials. REITs, and more REITs. That's where the strength is. That's the defensive area of the financials. When you get into the more aggressive areas of the financials, banks, asset managers, this is what we're looking at here. Not great action. And if we pull up the banks, I think there's a little bit more room to the downside here. And off of this uptrend, I think we established support being down closer to this 465, 470 area. We're currently at 477, so I think we're probably heading down into that area and likely to do it sooner rather than later. One last stock I wanted to mention, ABBV, and I'll bring this up actually in the relative chart that I use, and I'm going to scroll down so that you can see the settings. I always get a lot of questions on the settings that I use. Down here under price, you have dollar industry, dollar symbol colon dollar industry, dollar symbol colon dollar SPX, and dollar industry colon dollar SPX. That will give you all of these relative charts that I like to look at. ABBV, though, if you look at it, very, very big drop today, and the volume is just monstrous, over 15 million shares. We're not even the halfway point of the day. They came out, and I don't know exactly the news, but it was something having to do with one of their drugs, either not passing trials or the FDA needing more information or something along those lines. And the reason I pointed this out, if you're going to trade bios, biotechs or pharmas, you have to realize that it's not just earnings reports you have to be aware of. It is these announcements that come out from the FDA. You can see these stocks shoot up or shoot down. It's really difficult to guard against this risk unless you get into, say, an ETF that tracks biotechs or pharmas, because then you get a basket of them and you're not subject to this kind of a move in one day. And with that, I'm going to turn it over to Erin. I know she has an upgrade and a couple downgrades for you, and then we'll get into the big picture.
Yes, I do. Let's move on over there. Okay, so these are the lists of the upgrade downgrades. Today we only are looking at one upgrade and 3 downgrades. Really quickly here, I'm going to show you the RRG because I thought that was very interesting to look at. Sirius XM is leading by quite a bit, and I found it interesting that it's been downgraded. So I thought it would be interesting to look at the chart. Well, we're going to look at all of them. And CNP, which is also a downgrade, is showing an improvement as far as the RRG is considered. So let's actually look at these charts, though. I'm going to start with the upgrade. And I think this one is set up nicely. Got a nice breakout from that declining tops trend line right now. And I see a flag. And this breakout from that declining tops line would execute that flag. I have PMO buy signal. It's rising out of oversold territory. Scooter is moving. So it got upgraded, and I think it's a good place to be. So let's look at Centerpoint Energy. And I think this one it's setting up for something bad, but I'm looking at the PMO, and intraday, it's trying to turn back up. But if we do see that top or the sell signal below the 0 line, which given that it's just had a downgrade, I would be nervous about. We have a descending triangle. Excuse me. Those are bearish patterns, and you can see we're already trying to get below that confirmation line there. So if we get the breakdown from that ascending triangle, we could be looking at a move, about the distance of the largest move at the back. And that would take us right down there to that support at 25.50. So I know we're seeing a little bit of improvement in the energy sector, but I would say that one's not looking so great. Now this is Sirius XM. Remember, we looked at the RRG and it looked very strong, but there are definitely some points of weakness that should be pointed out. And the one is, of course, this PMO sell signal in overbought territory. Don't like it. This is really important support, guys, right here. And it is having there's difficulty in holding that level. We're still above it. And if we get a bounce off here, then I would honestly start worrying about little mini head and shoulders. So this one is definitely not set up well. And, it's interesting to see the RRG, but that takes a lot of intermediate term values in consideration. So in the shorter term, I don't like this. I'd be watching to see if that support line will hold. But I think with the downgrade, that might be very difficult. And finally, TransCanada Corp. And you can see a very large descending wedge, falling wedge. Those are bullish patterns. I'm not seeing, I am getting a little bit of confirmation here. If we get that PMO to bottom ahead of this previous bottom and we get that rising trend. That's why I put it in there, because right now it's still there. And that would be a positive divergence. And again, so you have this really nice looking intermediate term chart pattern. I would really want to see this improve, though. I see these rising tops here and declining tops. The PMO is telling us that this should be an okay place to be. So volume, yuck. It's just people have just, it's just been dumped. But we're setting up here. I worry, again, when you get the downgrades, I think there's some opportunities in there. But with the market so weak right now, I don't think I'd be bottom fishing at this point in time. With that, I'm going to pass it back to you, Tom, and you can introduce our new segment, The Big Picture.
All right. I actually thought you were going first because I was.
Oh, well, I can do that.
Well,
why don't you introduce it, and I will get my charts ready.
Okay. The big picture, what we're doing, and we've had a lot of feedback, or some feedback. I wouldn't say a lot of feedback, but we've had some feedback in the past where we have a number of intermediate term traders or even long-term buy and holders, those who look at the market beyond just what's going to happen over the next couple of days or few weeks or even a few months, and are more interested in looking at the big picture. What are we talking about in terms of how we evaluate the market from a longer term perspective? Let's not get, let's take 20 minutes and kind of get away from looking at the market with a very short term perspective, and let's kind of back up and literally look at the big picture to see, should we be concerned about, this becoming a bear market, or what would trigger that, those thoughts. Mm-hmm. And so, and everybody's got a different opinion on exactly what that big picture means. So Erin's going to take a few minutes and she's going to go through what the big picture feels like to her, and then I'll do the same thing and see what you think.
Right, because a lot of you will ask, and I know with Tom too, as he said, we drill down a lot, but we don't kind of step back and look at where do I need to drill down? What's the trend and conditions? And that's where you start. And I think in every presentation I've done on decision point analysis process, you start with the big picture, the market. What are the trends and conditions? And that is very important. And you can find very quickly, if you want to know decision points, timing signals and what we're looking at as far as the big picture, you can get those scoreboards. And this does give you the big picture. You can see that short term, and I think we all know it, momentum is bad. We've got, the short term trends are lower. This is 5 and 20-day EMA crossovers, and we got a -1. Midterm, intermediate term is looking okay, but momentum is shifted to the downside. So we can already see that weakness. And then if you want to move along, here's the NASDAQ. It's showing the most strength. It hasn't lost any of its intermediate term signals. It's telling me that there is, a momentum shift here, but we haven't gotten that short-term trend model sell signal. So what you want to do is, of course, understand, for me especially as an intermediate term trader, I don't want to jump in. And like I said, when we were looking at those downgrades, I don't, if the market is looking shaky, I don't really want to go look bottom feeding, because I think there's a lot of good chance that you're going to have problems, especially when you're bottom feeding, because you're looking at stocks and indexes or ETFs that are already in that downtrend, and you're trying to count on it to turn back up. And in a weak market, not always a good idea. So how do I determine the trend and condition and what's going on? Well, I start with my decision point live chart list, and you can actually get to all of these charts from my blog. I'll just show you really quickly so you can get there to look, and it's in my live chart list. So I'm going to show you these charts, but they're all available to you right out of my blog. Excuse me there. All right, so let's go back. So what I do is I look at, I saw those big board signals, but I want to get a feel for what's going on overall. From what I could tell, just from looking at those scoreboards, the NASDAQ 100 is your stronger area of the market. So I would probably be leaning toward the tech side at this point. because I know that it's showing a little bit more strength than, say, an industrial. The Dow Industrials have really been suffering. So I'm going to take a peek at these charts very quickly because I don't want to get too bogged down in actual, the details of the analysis. But, I'm looking at trends. I'm looking at these EMAs, and I use EMAs because they do put more emphasis on the data on the end, rather than the data that's at the back. It puts more emphasis on the most recent data. And, right now, I'm really concerned about these double tops and PMOs that are falling. I mean, look at the Dow has just really lost quite a bit here, and it was already struggling in comparison to the others. So intermediate term, again, looking at the weekly chart, look at this. This is a pretty solid rising bottoms trend line, and we still have room to move down here on the Dow. We're still looking, we could get down to that 24,000 range, and look at this very steep PMO heading down. So I know market conditions as far as industrials aren't looking so good. I'm going to go over here to the OEX. I'm going to go to the NASDAQ last. Again, another double top. And today I looked at this chart and I did get a sinking feeling in my stomach because we did see this penetration intraday of this confirmation line on the double top. If it makes the minimum downside targets, if we close down below the confirmation line, the minimum downside target is the length of this pattern. And that's going to take us down certainly to test that February low. So, we've been talking about, are we going to get down there to test that low? I would say at this point, yes, I believe we will. And let's look at the weekly. I think these are all very similar. And again, you can just see these rising bottoms trend lines and plenty of room for them to move down. And S&P, again, similar. We've been looking at this. We haven't gotten the breakdown from that confirmation line, but we can see the short-term trends are lower, and that's why we have those red arrows and gray minus signs for the neutral. It's just, there's so much weakness right now, and the NASDAQ is showing the least amount. And again, this is why I would be a little bit more inclined to go that direction. And I know, yes, it's aggressive area of the market, but at this point, it's been able to hold up. Even when everything else was moving down, it still had managed to not lose its momentum as much as some of the others. You can see with this very nice rising PMO here. It was very steep. We didn't get any whipsaw like we saw in those other indexes. Of course, now we have this very steep PMO that is moving lower. But what I would worry about more so would be if we don't get a bottom here above this previous bottom or even this one. I suspect we will get a bottom here before this one, but that drop below those confirmation lines. Now, in this case with the NASDAQ, I didn't really see this as a double top. I see the rising wedge. And the rising wedge tells you you're going to have a breakdown. Doesn't really tell you necessarily how large it will be. Some will say that it's the length of the back of this pattern. Of course, that would be extraordinarily deep, and I don't see that happening on the NASDAQ. But again, I think all of these chart patterns and these momentum shifts are telling us that in the shorter intermediate term, the market is weak. And even in that technology sector, there's still a lot of weakness out there. So again, not the time to bottom feed, probably the time to be looking at tightening those stops, certainly paying a lot more attention to your portfolio. And hopefully you've set up your chart lists of what you have, and you can start keeping a peek on, keep peeking at that to make sure that you're not going to get caught if we do go down and test that February low. So, but when you look at the weekly chart for the NASDAQ, it's not looking quite as bad. You've got that ascending wedge still in the intermediate term, and so we do want to watch that. Certainly this is holding up right now, that 17-week EMA, and I think that's positive, but I don't like the way we're setting up here in overbought territory for a negative crossover, and it's the only one that really hasn't done that on the weekly chart. So anyway, I don't want to take up all the time, but that's really, for me, before I even get started, before I even think about trading, I need to know what the overall market trend and condition is. So for me, that's the big picture. And you can find these charts in my Decision Point Live chart list. And if you don't necessarily need or want the annotations, I don't know why you wouldn't want them, but we also have the Decision Point chart gallery, and you're going to get each scoreboard there. You can select from the 4 scoreboard indexes that we cover, and you'll get the daily, the weekly, etc. And you can also get to those market condition charts. So that's where we're looking. And when the indicators, of course, are important as well. And I'm really having heartburn over these short-term indicators that are having issues and trying to fail. And you can see even with those intermediate term breadth and volume momentum oscillators, we've got the negative crossovers. I don't like it. No, sir, I don't like it. But we are still in a rising trend on these. So I don't think we've hit that, oh my goodness, I really need to worry big time here. But I would be very cautious because this is truly setting up for a test, I would say, of that February low. And what do you have for us, Tom?
All right. Well, I'm going to start just by saying, number one, for me, when I look at the big picture, it is about price. You can get a lot of interesting information that comes in different areas of the market, but really, you have an uptrend until you don't have an uptrend anymore. And so I've annotated kind of a channel on the S&P 500 that you can see on this weekly chart. This goes back since almost the turn of the century. But here was the bear market, the decline that we had 2000 to 2003, late 2002. Here was a nice little uptrend that we had, nice bull market through 2007. Then, of course, the financial disaster, 2008 and 2009, and then the recovery. And we continue to be in what I consider a very strong uptrend. So as long as this continuing uptrend and this up channel continues, it's really hard to argue anything but a bull market. Now, there are things that take place under the surface of the market. There are a lot of things that can affect relative performance. I've talked a lot about recently the dollar and how that can impact the relative performance of, say, the S&P 500 versus the Russell 2000. So there are a lot of different angles that you can take looking at this bull market. But when I look at price, I cannot think anything but bull market because we do continue to remain in this channel as we go higher. Now, does that mean that we have to stop selling right here at 2680 and move to new highs? No, I mean, we could continue to weaken. I know Aaron was just pointing out levels on the Dow. I mean, it's not out of the question. I don't think we're going back down there, but it's not out of the question that the S&P 500 goes down another 10% from where we are right now and still remains in this overall uptrend. Mm-hmm. We've had this move up for the last 2 years almost unabated, especially about a 15-month period of, you can see very, very little selling. So there's always that possibility that we're going to go through a period of selling. I think that the chances of that grow as we get into the summer months, where we do have a tendency historically to move lower. And we'll have a lot more evidence on what's going on with interest rates, inflation, and some of those other concerns by the time we get to the summer months. I don't think the rally's over, though, and this is why. When I'm looking at the big picture, I know that I've got an uptrend in play. I know I'm in a bull market. I like to try and evaluate the sustainability of a bull market. And what I mean by that is a healthy appetite for risk is what drives bull markets. Being defensive does not drive a bull market. Bull markets require traders to take risks and to shun defensive areas of the market. So what I've included on this chart, first of all, at the very top, you can see the PPO. And by the way, the PPO will give you some bad signals from time to time. If you look at this throughout most of the bull market, you'll see the PPO in positive territory. When you get into bear markets, the PPO is negative. Here was your bear market. Here's the PPO staying in negative territory. But there will be some whipsaw sometimes, and you can see this back in 2004, where the PPO goes below the center line. 2006, we go through below the center line. Neither one of those began a bear market. It was simply that the mathematical formulas went into negative territory. If you look at the price action at these negative PPO readings, we didn't really have, I mean, here we broke out above, I don't know what this level is, maybe 1050, 1060. We went back and tested it, and at that point, the PPO went negative. We continued putting in higher highs and higher lows, and even here, as we came down, we were holding a trend line. Price still was fine, but the PPO goes negative. So I always talk about my primary indicators and my secondary indicators, and I love the PPO and the MACD, but they are secondary indicators to me. They are not the primary indicator. If the MACD crosses a center line, that is not automatically going to mean I'm going to turn bearish. I think it needs to coincide with price action being bearish as well. So as I look again, I've got this beautiful move up, nice uptrend. PPO is well above the zero line. I don't see anything in terms of price action momentum that I need to be worried about at this point in time. So then it comes down to, okay, what's going on beneath the surface? And I've pointed this out many times, but in 2007, as we were making the final highs in October of 2007 in that bull market, I want you to check out what was going on in the XLY XLP. This is a ratio of consumer discretionary to consumer staple stocks. I personally think this is one of the most important ratios to follow in the stock market, just because you're comparing the more aggressive area of consumer stocks, which is discretionary, to the more defensive area, which is staples. And so if the ratio is going higher, it's telling you that traders are remaining with a very high risk appetite. If it starts moving lower, it's telling you the exact opposite. At October 2007, we were starting to fall apart on this ratio while the S&P was still setting new highs. That's a warning sign. When we bottomed, check out the bottom. When we put in a lower low on the S&P, we actually put in a higher low. Money was starting to rotate more towards the aggressive area, the more aggressive XLY, and that marked a bottom. And throughout this entire uptrend, for the most part, you can see that we continued moving higher in this ratio. Now, I have gotten an email from someone who made a very good point, saying that, am I concerned that Amazon represents such a huge part of the XLY? And if you look at the equal weighted consumer discretionary versus consumer staples, we haven't yet made a high. And I thought that was a good point. We are trending higher, by the way, but we haven't taken out highs. I think it was from maybe 2014. And I'm sure a lot of that is the Amazon effect. What I'm most concerned about is the direction of the ratio. So if I'm going higher and the S&P 500 is going higher, I'm feeling pretty bullish. If the S&P 500 is going higher and I'm sideways consolidating, I'm okay. What I don't want to see is the S&P 500 going higher and this ratio completely falling apart. So that's something to keep in mind. Other areas, transports versus utilities. Recently, we just got a breakout on a relative basis. Transports do well in a strengthening economy. Utilities do better when the economy is suffering and treasury yields start dropping. So if you get a breakout in this particular ratio, I think that's a good sign that once again, traders are willing to take on more risk. Banks versus REITs. This is an interesting area within the financials. And I know that back in 2000, obviously 2007, 2008, we had a financial crisis. But you could see well before that, this ratio was turning lower. This was not looking good for banks well before that bear market started. We did go sideways for a while. We had to get through periods of quantitative easing and a lot of the impacts that had on the banks. But what I'm seeing now, especially over this last really strong period to the upside on the S&P, is a solid outperformance of banks relative to the REITs. So I think this is a very bullish development now that we're starting to trend higher here. The Russell 2000 versus the S&P, I could get into a long dissertation here, but there's a lot of impact of the dollar in this ratio. I do like the fact that the relative strength here is holding, this relative support area is holding, and over the course of the last several weeks, we've begun to see small caps outperforming. I think that's bullish for the market as well. So I'm not, again, when I'm looking at the big picture, I do take into account all these different signals that I'm getting from underneath the surface, and that adds to or subtracts from the bullishness I feel for the S&P 500. In other words, we could be in a bull market moving higher, but I could be starting to get very cautious if some of my under the surface signals and ratios are not supporting the move to the upside. But I don't feel that's the case right now. I think the market still looks pretty good underneath the surface. And so I would be really surprised if the S&P 500 were to drop back into, say, the 2,400 area. Let's see, dollar behavior. I can go into a couple of different charts, but the one I tend to look at is the one I've shown multiple times here over the last month or so, which is just looking at the U.S. yields versus Germany. We continue to rise. The dollar normally follows the direction of U.S. yields minus German Treasury yields. And you can see overall from left to right over the last 10 years, we've been going higher. The dollar from left to right has been going higher. But we do go through periods where we have divergences, negative divergences, where yields are moving up faster here in the U.S., but the dollar falls. Yields are moving up faster in the U.S., the dollar falls. And currently, we are seeing the yields moving up faster here in the U.S. and the dollar falling. The last two times, the dollar has exploded coming out of these divergences, and that has led to significant outperformance in the Russell 2000.
Hey, Tom.
Yes.
Just take the screen back. We have the summary slide up right now.
Oh, okay. Hold on. Okay.
There
I don't know when that went out. Did it just
went to the dollar, I think so.
Okay. Well, the big thing here is just that there are divergences. Normally, the dollar strengthens if U.S. rates are moving up faster than rates in other parts of the world. That helps to strengthen the dollar. So I was just pointing out a couple of periods where we have seen divergences, where the yields have been going up and the dollar has not. The dollar actually has gone lower. And in those subsequent periods, we've seen the dollar play catch up very quickly back to the upside. And during those periods of strength in the dollar, that's when we've seen very strong outperformance by the Russell 2000. And I mention all of this because the dollar, to me, remains in a very critical area of support near 88 to 91, in this zone right in here. I'm expecting the dollar to rise, and it looks to me like that's what the market is expecting, with the Russell 2000 beginning to outperform. But this is another, the dollar is something else that we need to keep in mind, because it has impacts throughout many other areas of the market, like commodities. Commodities tend to do much better relative to the S&P 500 when the dollar is declining. And the opposite holds true when the dollar is rising. And that is why, in my opinion, commodities have not participated in this bull market, because this has been a bull market of a rising dollar. Much different than what we saw in 2003, 2007. And I won't go into it, but the next step that I would take is, if I feel good about the market, I'm going to be looking at industry groups within those four aggressive sectors that are performing well. So the XLK, the XLI, the XLY, and the XLF. Those are the four ETFs that track the aggressive areas of the market. And I'm going to be looking for industry groups within those that are outperforming to try to drill down to find individual trades. So I still think from a big picture perspective, we look really good. So we can do a quick summary, and then we can move on to the Scooter report. And I will let you take that away, Aaron.
All righty. Let me start off with what I'm going to do is just give you the what's happening right now as far as the scooters. And I think you were going to look at the scooter report in general. So, Tom, so I'll just start over here. So top 10, again, these you can set up right here anything you want in these. And of course, I like this one quite a bit. But right now we're looking at scooters. And of course, we can choose large, mid, all of that. I'm going to stick to the large cap. These are the top 10. These are the ones that are leading. These are the guys with the highest batting averages. These are the ones in those very strong rising trends. You see people like Amazon, Netflix, Micron. I did a quick RRG just to see what that looked like. Look at all that green. And there's only a few of these right now that are showing some weakness. The rest of them are doing very well. So if you want to get, grab onto the coattails of something that's already doing well, this is a lot of times you can find some intermediate term trades there, because they just have high batting averages. Their scooter is already high. But who's moving right now? That's what I like to look at. Who's moving their rating the fastest currently? And at this point, again, there's a couple of ways to do it. you can go into your candle glance and look at that. I like to do that when I am in my other account because it gives me the PMO. And so I can see if there's any prospects in there. We've got the RRG right now for these. And look at, of course, you're going to see a little bit of a move to the right, to that northeast if you're getting a big scooter move like that. But this also takes into account, a full year with the RRG. So, to see all of these turning up, this is why the scooter is so helpful, is we can find these improving ones in that top 10, as well as the losers. Of course, we were looking at AbbVie earlier, and yeah, bad day. So not a surprise. We've had a 50 point change in this scooter. Again, let's look at the RRG for these guys. All right, so this is interesting because you can see, of course, AbbVie was in that leading category. It's starting to travel the wrong direction, but it's still in a leading position in that quadrant. And Baidu, that's an interesting one. So far, we're getting, it's moving in the proper direction, even though it's lost a lot of scooter rankings there. So I'm going to go ahead and we'll look at Baidu very quickly. Baidu. All right, we're coming down right now to test that 200-day EMA. You've got the PMO sell signal. So this one, you can see the scooter is just falling off a cliff. So there is some warning signs here. And, that 200-day EMA looks good to be a possible area of support. But again, market weakness, you can see that area right there is also some very major support right about 225. I would keep an eye on it. At this point with momentum and that scooter falling so deeply, though, that's a problem. Let's go look very quickly back, and I'll give it back to you, Tom. I want to look at those top ups because let's face it, we want to see where the opportunity may lie here. So I would be looking more in that improving category just because that shows a little bit more strength going on there. Bottom feeding, maybe you want to look in these lagging, in that lagging sector there. I'm going to look at, I know we were looking at REITs, or we've had some question about REITs, so I'm going to take a peek at AMT, American Tower. And remember, these are the ones making the biggest scooter moves. And, while it's not a 30 or 45 move like we were seeing on some of those, the loser stocks, it's still going in the right direction. You can see the PMO is even trying to turn back up. OBV, not the greatest, but we have some support here lying right about the 50-day EMA. But this level here, that support level, it was broken yesterday, and we're trying to pop back up above it, and we are getting that big scooter improvement. So it's something to watch. I think it's a great way to get in there and just see what the leaders are, and then understand by looking at an RRG, that gives you a pretty good picture of, those top up, top down. So anyway, pass back to you, Tom.
All right, sounds good. First thing I wanted to do is, before we get into the scooters, is just give you a little background of what I've talked a number of times here over the last couple of weeks about the small caps. I am a fan of the small caps. And so I want to just throw in the seasonality of this group so you can get a sense of what we typically see out of small caps as we move into April and May, June, and so forth. Here's the Russell 2000. You can see, first of all, that in the month of March, which is what we're in right now, we have gone up on the Russell 2000, 75% of Marches dating back over the last 2 decades. So roughly 15 out of the last 20 years, we have seen Russell 2000 move higher in March. So when we're seeing this outperformance right now, and we've been seeing it throughout March, we shouldn't be surprised. This historically is a good month for small cap stocks. Another way to look at this, though, is to take a look at how the Russell 2000 performs relative to the S&P 500. So you can still use the seasonality. What you can't do is go up here and put in RUT versus SPX. You can't do it this way. Well, that's the sharp chart. On the seasonality, it won't let you do this. So if I try to do it this way, it's not going to come up. It's going to say an error occurred. What you have to do is you have to go in, you type in your Russell 2000 under seasonality, and then you bring up versus the S&P 500 where you compare it. And you can compare it to anything you want. So you could compare individual small cap stocks to the Russell 2000, or you could take Apple and compare it to the Dow, or whatever you want to compare. But here, and the default's 5 years, so I drag it back 20. And what you're going to find is that in March, the Russell 2000 does have a tendency to outperform the S&P 500. 65% of Marches going back, again, over the last 2 decades. And what I find really interesting is when we get to June, it's almost 80%. And small caps outperform the S&P by 1.5% in the month of June. So we definitely want to keep that in mind as we go forward. But when I looked across this and added across, we're up almost an average of 3% on the Russell 2000 over, versus the S&P 500 through the first 6 months of the year. And then when you get to the last 6 months of the year, the outperformance shrinks to less than 1%. So we are in the sweet spot for the Russell 2000 to begin with. And if I'm right about the dollar, I expect that we're going to see the Russell 2000 continue its recent outperformance. So that's how I wanted to start. And then from there, I wanted to just go in and show you, if you know that you like the small caps and you go into the scooter reports, you can then click on small cap stocks and it will rank those in scooter order for you. Now, I went back to about the 75 area. I think I ended up just grabbing like the 5th page here. Yeah, I was in the 75 area and I started looking at some of the industry groups that I like and just looking at individual stocks within those industry groups. And the first one that I came up with was ILG in the travel and tourism. I'm looking to see if I could find it here, but it should be somewhere around the 70s. There it is, travel and tourism. So it's got a scooter rank of 77.7. There's ILG. I'm going to pull up the chart, and I'm going to show you this one and 2 others, and then we'll wrap up. But ILG, if you put it on a relative chart, shows that, number one, we've been advancing pretty nicely. We had a huge gap up here on very heavy volume. We're testing the top of that gap support, so that looks pretty good. Travel and tourism just recently broke out to new highs. That looks good. The stock relative to its peers is holding up pretty nicely, uptrend, sideways consolidation in terms of relative strength. And then ILG relative to the S&P, we could use it versus the Russell 2000. But ILG here, you can see on a relative basis, is performing well. And travel and tourism broke its relative downtrend. And here in March has been performing very well on a relative basis. So that's one way to use scooter reports. If you already have an idea that you like small caps and you have a general sense of which industry groups you're interested in, you could use a scooter report in that fashion. 2 other quick stocks, KNX. I'll also pull these up on these relative charts. KNX, big gap up with earnings, pulled back, held gap support, starting to turn higher again. Here is the trucking group, which it's part of, performing very well. KNX relative to the trucks, I think holding up fine. And then relative to the S&P 500 actually breaking out, and the truckers relative to the S&P breaking out. So again, start with a concept, find individual stocks using the scooter report, and then you can kind of look to see how it stacks up against its peers, against the S&P 500, and how its industry group stacks up relative to the S&P 500. Final one is ePay, not eBay, ePay. Bottom Line Technologies, beautiful chart. It is in the software space. Software has been coming down, but that could be an opportunity. ePay relative to software, getting close to its relative high and has been strengthening recently, versus the S&P obviously continuing to move higher. And then here's software on a relative basis pulling back, but this clearly has been one of the strongest areas in the market over the last year or so. So anyhow, that's a way you can do it. If you were late, I did show this earlier. All right. You can go back and look at the recording later, but I did show my relative charts and showed you how you can set those up at the bottom of the page. So if you weren't here earlier, make sure you go to YouTube or come back to Stock Charts later today, check out the recording, and you'll be able to get that. And here's what we just went over with scooters. Aaron covered the top 10 up and down, including Baidu and AMT. And then I looked more from a small cap perspective, showed you how you could use that scooter report from the members dashboard. And we looked at ILG, KNX, and ePay. And with that, I'll let you take the screen, Aaron, and maybe take a look at those 10 stocks.
Yes, and I got them in just in time. All right, so here are the ones that everybody did request today. And when you look at them on the actual RRG, I mean, some of them just stick out to me. Zen looks like one that'll be interesting. Micron, GDL, XLU. So those are some of the ones I'm looking at. We'll take the top vote getter, though, in the chat room. So like any of the symbol requests that are already in there, because they're already in my chart list, and that will be the second one that we do. And don't worry if your stock is in the red here. That doesn't mean we won't look at it. I do usually look at it by sector and industry and try and kind of mix it up for us. So just to give you a little bit of my methodology for picking the 10 and 10. And back to you, Tom, for the first one, Deere and Company, DE.
Yeah, DE I think looks pretty good. I mean, we had a nice uptrend at the very top as we kept moving higher. You can see the PPO struggled to break that earlier high that it had back in December. So there were signs maybe of a little bit of issue with momentum. I think also in January at these highs, you can see that the volume had really dwindled much below average. So I think there was maybe a double shot of problems for Deere as we moved toward the end of January. And then, of course, the overall selling in the market didn't help. But Deere did rally back, and you can see on a intraday basis tried to make a breakout. And again, when you get those false breakouts like that, you want to be careful in the short term. We ended up making our way all the way back down to the bottom of the range, printed a reversing candle, worked our way back up to the top, another reversing candle, and back down again. But I do think Deere sits close to key support around 152. So I like it. I think eventually we're going to get a breakout on Deere. You can keep, the thing I like about it is that from a reward to risk standpoint, you can keep a stop fairly tight. For me, I think if Deere were to close below, say, 152, that would be a problem in the very near term, not long term, but near term. And so I would be interested maybe in just taking a small loss and moving to the sidelines. But if it holds and we make our way back toward that 170 level, I think, it's more than the 10% gain.
There you are. Okay, so let's go to the top vote getter currently. It is tied between the SPY, but I think we've kind of covered the S&P 500, and AMAT. So we'll go ahead and do AMAT.
Yeah, I think, first of all, I love the semis. And so AMAT kind of is right in that sweet spot. A couple things to watch for. It has been performing really well and holding on to rising 20-day moving average support. We've now seen it twice just over the last last 4 or 5 weeks. And that was a nice little hammer that printed on the 20-day moving average just before we moved up to challenge the recent high. I think we're in a fairly tight 58 to 62 short-term range on applied materials. But unless the market really falls apart, I'm looking for a breakout here on AMAT. I like it.
Okay. Let's see. The next one I have for you is Zen, Z-E-N, Zendesk. I love that stock symbol.
Zen. You got to like Zen.
Yes.
Yeah, I like the chart. There is a slight negative divergence, so you do need to be aware of that. So let me just point that out here. We got higher prices and a lower PPO, but there is your slightly higher high. Here is your slightly lower PPO. Now, if we keep moving up, it's very possible that the PPO keeps rising up with it and eliminates this negative divergence. All this is maybe just a little bit of a warning when I see these negative divergences. In the case of Zen, we did make the breakout yesterday on pretty strong volume. So if you're looking at this as a sign of slowing momentum, volume would tend to argue against that. I mean, we opened on the low, closed on the high, and we had a pretty strong volume day. So I'm not overly concerned about that negative divergence. But a pullback to test the rising 20-day moving average, we've seen plenty of those over the past couple of months. So I like the stock. I just would prefer getting it closer to that rising 20-day moving average.
Okay, let's see. Schlumberger, SLB.
Yeah, energy finally has picked up a little bit in recent days, and Schlumberger kind of took that ride, but it's in a bear flag formation. I'm still thinking more bullishly. I'm not thinking bear market type rules here, but it is a bear flag. I mean, you have a downtrend, sideways consolidation. So I'd be careful and I would respect a breakdown below 64. Otherwise, I would just trade this range until we break one way or another out of it.
All right. The next one, DQ. I was hoping it was Dairy Queen, but no, it's DACO New Energy Corp.
Yeah, Dairy Queen would be interesting.
I'm thinking food.
Always talking food around lunchtime here on the East Coast. Not good. Yeah, this one I think I like the increase in the volume that we saw yesterday and the move back through the 20-day moving average. And it is in a space where we're starting to see some renewed strength. So I think that combination right there, and then I just maybe circle that move through the 20-day moving average right there. I think that's a good sign. Now, can we get back through the 50? That remains to be seen. I think we do have very important price support at the recent lows. We could go back and there's a gap support. Then we could also right in there. That was the prior high before we got the breakout on big volume. So I think this is a key area of support, and we've been holding it. If you close back below 43, that would be a problem. You might look at it and say, well, I'm almost 52. That's a lot of room to the downside. Well, if this is starting to trend higher, you might consider the rising 20-day moving average. Looks like the 20 days just starting to turn up. You might consider that as a tighter stop. But you want to get through the 50. If you get through the 50, then I think we got a shot to make a run at 63.
All right. And on the subject of food, how about McDonald's? It looks pretty good to me. I mean, I could see possibly a reverse head and shoulders, maybe getting ready to set up PMOs on a buy signal.
I'm going to say maybe an inverse head and shoulder off of the recent high right here. Let me just draw that in. Actually, I'm going to go out a little further. Let's go 10 months. I think it'll give a little bit more of an uptrend maybe that we can see. All right. Yeah, the uptrend is pretty clear. My big problem with McDonald's is that we have been seeing a lot of relative weakness relative to its group. But there's your uptrend in play. Now, normally, I'd have to see if it goes. I think McDonald's had a very long uptrend. But this is a pretty steep, a very deep inverse head and shoulder pattern. So what I would be looking at here, if you're going to trade based on a pattern, would be the reaction high right here coming across to there. It is slightly downsloping, as you can see. That bothers me a little. But here would be your left shoulder over here. Here's your inverse head. This would be potentially a right shoulder. And we could see it drop a little bit further to get more of a symmetrical kind of a inverse head and shoulder. I'm still a little cautious, though, just because we've been seeing so much relative weakness relative to its peers. So I need to see more out of McDonald's. I'd be more interested on the breakout. I think if the volume comes in and we can get back through 163 and you see the PPO turn positive again, that might give me a little bit more of a sign to get in with the rising 20-day as my stop.
All righty. Let's see. The next one I'm going to give you then is APA, Apache.
Yeah, this is one that Greg Schnell talked about. And he had mentioned that they had a lot of good news out there, but the stock price when he was on here was in the dump. But he did say that there was a lot of great fundamental news, and maybe that's finally catching up here with the stock a little bit. I like the move back through the 20-day. That was a huge day it had yesterday. Volume was average. It wasn't huge off the charts. I would like to have seen a little bit more volume. But just keep in mind that this whole space has been a relative underperformer when you look at it relative to the S&P 500. So if I got into any of the stocks in this space, I'm going to make sure I really follow my stops. I don't want to be in a stock in an underperforming group relative to the S&P 500 if it starts to break down. So it would have to continue to maintain its bullish move that we've seen here so far in March. So what that means to me is you can see that 20-day starting to turn up. If we close back below that 20-day moving average, yeah, it wouldn't bother me at all to let go of the stock. Because again, you're in a group that is a relative laggard. And if it starts to turn back down again, I don't want to take any chances.
All right. The next one in the financial space, Deutsche Bank. And I look at this chart and I think of Tom Petty's song, Free Fallin'.
Yeah, I'm going to use this one relative to the. This is a typical. This is a bearish breakdown of a bear wedge, no doubt. Here, or excuse me, a bear flag. Here you've got the decline. Here you have got equal lows. It's actually a descending triangle, which is very bearish. I mean, I normally wouldn't be looking for these kinds of patterns in this market, but hey, it is what it is. And we broke down and look at the volume confirming. So I think looking at this, first of all, I would annotate by drawing support coming across here. There's a bunch of support there at 15.5, and even prior, we had these lows at about 1570. So that 1550 to 1570 area was pretty strong, and we had already bounced twice before we had the big drop here on heavy volume. And look, the bank index has not been that bad, but Deutsche Bank, on a relative basis, it actually hit a relative high all the way back in May and has been downtrending. So not only do you want to get in groups that have been performing well relative to the S&P 500, but you want to get in stocks that are performing well relative to their peer group. Because here's the bank. The banks have not done badly against the S&P 500, but DB has been horrible relative to the S&P 500 because it's been horrible relative to its own peers. So I can't make an argument for this one. I don't like this heavy volume breakdown. I think there are a lot of other banks look a lot better than this one.
I totally agree with you there. Excellent analysis. Okay, Micron Technology, MU. I'm holding it long term personally, that and RYT, the equal weight technology.
Yep.
Yeah.
I love it. I love Micron. I will say I think they report earnings today after the bell.
Yes.
I think I saw that. So you, as long as you're comfortable, I mean, we've had a huge run. There's no doubt in my mind. I say this with about 99% confidence. Micron's going to beat its estimates. I mean, a stock, I'd be shocked if a stock runs from 37.5 to 62.5 right before its earnings reports and then, lays a dud. I would be shocked. So I think the earnings report's going to be strong. The question is, have we already built in those results into the price? Because we could get a great report, a great upbeat outlook, and see the stock drop just because it's a buy on rumor, sell on news kind of event. So I would not hold into earnings because, again, that's not my style anyway. But if I had a pre-earnings run-up, if I owned the stock for a pre-earnings run-up like this, I wouldn't take any chance with it. I'd book my game. But looking at the stock from a from a technical perspective, there was your breakout at $50. I think as long as it holds $50 going forward, it's a great looking stock, and it's up at 58 and change, almost $59. So you could be looking potentially. I'm not saying it's going to fall to 50, but potentially it could fall to 50, which would be close to 20%, and still be fine technically, in my view. So I like Micron, but when you look at the semis, they've been strong. Micron, this is the exact opposite of what we just talked about with Deutsche Bank. Micron is one of the best stocks in the semiconductor space, has been for the past couple of months. Versus the S&P, it's very strong, and you can see semiconductors also broke out. So the way you make money in the stock market is being in strong stocks in strong sectors, and I think Micron is a perfect illustration of that.
All right. And our final one is TXRH. And somebody said they got this in my PMO scan, but they must have run it a little while back because I'm not seeing what I'd want to see.
What was the ticker? I'm sorry.
Oh, TXRH.
Oh, Texas Roadhouse. Okay.
Yeah.
I love it. It is an ascending triangle off of an uptrend. The thing that's holding it back is the market. I mean, that's really what I would say. I mean, you've got the high here. You've got a lower. Well, the first drop, you basically came back up and tested the high. You came back down. You put in a higher low. Again, came back up, tested, put in a higher low, and now we're trying to test. So that would be the price resistance that I would draw. And then I don't know. I mean, you can draw intraday. You could do it there. You could maybe. It just depends on your own style, but something like this. Connecting candle bodies. But no matter how you slice it, I think you've got an ascending triangle that I would expect is going to break out in time. So I'm a bull and a fan of TXRH.
Perfect. All right. That's it for the 10 and 10. And there are our symbols that we covered. I will have those up in the Market Watchers Live chart list with annotations that Tom just did. Just go to the Market Watchers Live blog, and the link to our live chart list is right there at the top. So you'll find them there. And with that, before you put the ChartCon chart up there, I just wanted to show that TXRH, because I do agree with you. The only thing I'd be a little worried about is, of course, we do see the PMOs starting to turn down, and we're in a broadening pattern. But I agree with you. I think that ascending triangle trumps that broadening pattern. Those are broadening patterns are generally not good. I don't pay too much attention to them, except in a case like this where I sort of want to get an idea of what's going on. But I do like the pattern. So. And with that, let's go to ChartCon. Well, I'd like to go to ChartCon right now, but we have to wait until August. It's so much fun. Anyway, it is an online conference, so you do not have to leave. And I would guess if anybody's in the chat room, they would probably agree. If you went last time online, it was a great time. And, you still could participate because we have an app that runs in the background, so you can chat with other people who are watching. We will talk with you. We'll put pictures up there. So even if you can't be there in person, it's a great event. And of course, we're going to be centering our talks on reducing risk. We have amazing, amazing speakers for this. You'll recognize quite a few names. And I'm looking forward to talking to Dr. Elder again. I talked to him. He wasn't at the last one. He was at the one before that. So it was like 4 years ago. And I really enjoyed my discussion with him. It'll be interesting to see. David Keller was here yesterday, and we got some great feedback on his presentation. He will be there doing a presentation as well. But if you do want to join us and join in the party and the fun, you can do that. You can join us in person. We will stop talking about this, I think, when we hit April. So is today the last day, maybe? Tomorrow. Because we will no longer be taking seats for the VIPs, which it would be coming to the actual conference. Let's see if I have this in a better place here. There we go. So yeah, March 31st is it for signing up to be a VIP to join us there. It's a great time. Personally, if I were going to do this, I would totally do the VIP and cruise. I think it's a great price for a 7-day cruise to Alaska. And on top of it, you get to enjoy our company. We usually don't hide out in our hotel rooms. We're usually out and about. So, and happy to sit down and talk with you. So being a VIP is a lot of fun. And I think for a summer vacation, this is a great way to do it, and possibly a write-off for some of you. So something to think about. With that, let's go ahead and get into the market updates. And we'll look at what's going on right now in the 2-day 10-minute bar chart, I think is what I have it set for. So we'll go to the candle glance. There we go. All right. So what's going on right now? Actually, I'm going to add the TSX. Maybe I'll be able to talk them into changing this for us. I like to see what's going on in the Canadian market. All right, here we go. Dow, everything's down. We all pretty much know that. We hit intraday lows, though, about when the show started, and we had seen prices move up from there, but we're heading right back down, probably because our show's ending. And anyway, the TSX similar chart patterns we can see hit the intraday lows, have turned back down. I would be a little concerned that we're going to test these intraday lows once again. I suspect that we will. UUP, the dollar is up, gapped up, and is moving back down just slightly. You can see commodities gap down and are moving sideways along with USO and oil. $13 is where we're looking at USO right now. Gold has been steadily moving down since the gap down at the open, currently reading GLD at 125.73. And we can see volatility index is definitely getting higher. We've been spending most of our time today above the 20 reading. So there is some nervousness coming out there. And we can see that we're still looking at plenty of declines going on right now. Let's go to the market summary and see very quickly where we're standing right there. And I will do this by percent change. Everything is red. Red, red, red. There we go. Utilities, as Tom was saying early in the program, pretty much the only area doing well, although you can see the other defensive sector, consumer staples, is now positive, up slightly. But you can tell when we have these defensive sectors in the top, there's some problems out there. There is some worry, and that does go right along with what we're seeing with the VIX right now. Utilities, as far as industry groups go, the industry indexes and REITs following as the only positive industries right now that we're tracking here. Banks, broker-dealers, drugs, disk drives, all down over 2% right now. International ETFs, all down right now. Japan ETF is doing the least bad, I guess you could say. It's not doing as bad as the rest. And we can see it's still down 0.3%. The big laggards, down almost 3% is the China ETF, followed by emerging markets, which is down 2.63%. So that gives you an idea of what's going on in the market currently. And with that, I'm going to pass it back to you, Tom. Did you have anything you wanted to add to the market update?
Yeah, I wanted to just add one more thing, and that is just kind of looking at what's going on with the S&P 500 and what's also going on with the 10-year Treasury yield, because there does tend to be somewhat of a positive correlation between the two over longer periods and shorter periods. So I'm going to pull up a 5-day chart, and I think hopefully you have my screen here.
Yep.
Okay. Here on the top is the S&P 500, and down below is the 10-year Treasury yield. Now, the yield recently was climbing, but remember, we're still in that trading range, 280 to 295. The S&P went down with the 10-year Treasury yield, kind of started to move up a little bit, and then, of course, today when the yield dropped so much at the open, S&P 500 also dropped. One way to look at this is anytime that the Treasury yield goes down, as I mentioned earlier in the program, you've got money moving into treasuries, which is defensive. And when the market's defensive, normally we're moving lower. And so that it all kind of makes sense. But when I look at the 10-year Treasury yield, you can see we've made a pretty nice move here back up to the 2.84 level off of the 280 test. And as we were moving up, you can see the S&P 500 basically bottomed at the same time, but has started to roll over, even though the yield has continued rising. So this this relationship, I think, is going to be really interesting to watch the next few hours into the market close to see whether or not, if the 10-year Treasury yield continues moving up, to see whether or not the S&P starts to erase some of the losses that we've seen so far today. But that's one thing I'll be watching later in the program.
You know, I forgot to show everybody my VIX chart, so I'm going to do that, and then we'll go on to agree, disagree. Because whenever I see the VIX making those moves like that, I want to look at my climactic indicator chart. This is a breadth and the VIX. I invert my scale because when I'm looking at the VIX in the very short term, I am looking at it as a sentiment indicator, and sentiment is contrarian. So if everybody is extraordinarily nervous, you'll generally see a bounce the next day. If everybody is euphoric and you get the penetration of the upper Bollinger Band, now everything is a little bit overbought. And you know, one thing I would mark here in the thumbnail that'll give you an idea of what I'm talking about. We got that penetration of the lower Bollinger Band on some very climactic breadth readings, and generally I look at what the trend was before that, and it was falling. So typically I would look at that as a selling exhaustion. Well, we didn't get much of a bounce after that. We did test you know, that high we had back here from that day. We ended up consolidating before we took the dive. So that's what I'm talking about in the very short term. It gives you an idea of kind of what to expect as far as a possible shocker in the morning. And this one told me there was likely a selling exhaustion. I'll have to see what the breadth readings are, but I would say I'm looking at the same sort of thing. Although since we did consolidate and now we're dropping, This could very well be more of an initiation. And I'll be, again, looking at those breadth indicators very closely, and I will write about it in tonight's blog, so you'll get to know what happened. And with that, let's go ahead and do our agree, disagree. I have not looked at the poll yet to see what everybody is saying. And I think it's pretty interesting right now. So the question is, and I think we have it up there right now, do you agree or disagree that in the end, price is the only thing that matters? And I know these questions can be a little bit ambiguous. But think of this question, as I said in the chat room, as sort of a desert island question. In an imperfect world, or if you were on a desert island, like would price be enough for you? That's sort of what we're talking about with that question. So you can go in there and change your answer if you wish, or go ahead and make your answer. Just click the polls on the top of the chat box, and there we go. Do you want to start?
No, go ahead. You got take the screen. Go with it.
All right. Well, let's do this thing then. I am going to say that I agree, and I will explain my reasons why. Price, I don't think it necessarily is the only thing that matters. Obviously, we have opportunity to look at many other things, but if I only had one thing to look at, if I were on that desert island and you gave me price, would that be enough? I say yes. And my reasoning is, my decision point trend models are all based on the EMAs of price. So the only, if we're counting price is all that matters, I would say that anything you can develop from price counts. So that's my caveat. I don't know if that was what you had in mind, Tom, but you've got all of my EMAs, and that tells me the trend model. So that's what gives me those arrows on the top of my decision point charts. Let me go right here, the scoreboards. And again, you can get those right here. So the trend models, it's all based on price, right? It's just the moving averages and their crossovers. So that would be great. And then, the PMO is the other half of my scoreboard. And the PMO is based just on it's a rate of change. So the only thing that's going in there are moving averages, and the price is what gives me my momentum, and MACD similar. So I've got that going for me. But what am I losing? Well, I have a lot of volume indicators, so I am losing some of those. The ultra short-term indicators has breadth in it, so I don't know if that would work. Are you guys seeing my charts?
I am just seeing agree or disagree. I didn't know you had charts up.
Oh, yes. I was looking at some stuff. Not anything overly exciting here, but just to illustrate. So a lot of my indicators are based and have volume and breadth considered in there. I didn't consider breadth because although that's, advances, declines, it is sort of just price based, but any of my volume indicators I'm going to lose. I'm going to lose looking at volume patterns, but ultimately I still can look at PMO analysis charts, because those are based simply on the PMO, which is based on price. McClellan oscillator is just based on price and moving averages. Price is above their 52-week averages. So I guess I would say yes, if you can include the moving averages, because I think really those are critical to my analysis process. But I lose out on the market conditions, some of my indicators that way, and I lose out on the OBV, money flow, force index, anything based in volume. And I'd hate to lose those, but I think I could if I had to.
Okay. Well, I'm going to take the screen for a second. I went back and forth because I really think it's how you interpret the statement. I wrote it. I wrote the ambiguous statements. Everybody can blame me for that. But I believe that there's a lot more than just price. I think price is certainly one of the biggest items, if not the biggest, but I don't think it's the only thing that matters. As a trader, for me, I have to have volume. I have to know what the volume is, because you get a lot of just common gaps. I trade a lot of gaps, mostly earnings related, and I would need to know the volume on those gaps to get a general sense of how I want to trade the gaps. So for me, price obviously is very important because you can't really manage your reward to risk without knowing what the price is. But it is not the only thing that matters to me. I need to know what is driving that price. Is it volume or is it not? I pulled up Snap simply because this to me is just such a bullish candle with over 200 million shares trading, gapping up to 17 and trading and closing near 21 tells me that there was a lot of buying taking place. And off of a downtrend, that volume becomes really important because otherwise, looking at this move that I've seen here over the past 5 to 6 weeks, if I didn't have volume as an indicator, I'd be out of Snap. I would not like it, but I still like the chart actually. I think we've just come down here, tested the 50. I've said before, I think we have a bullish wedge, but the volume is really the thing that keeps me in this one, that makes me feel confident that Snap is going to snap back.
Mm-hmm.
So I think the volume would be a missing piece for me that I really would have difficulty trading without. I always say that my number one indicator is the combination of price and volume. And we've had a number of guests on here, and I'm not sure what the percentage is, but I'm going to say that, surprising to me, a high percentage of people that we come on here don't really talk about volume.
No.
And and even Dave Keller on yesterday was talking about how volume can be very misleading at times, and I suppose it can. But for my trading style, I need it. I need it for the confidence factor, to know where I want to set my stops, where I want to be entering stocks. If I just saw a gap, and there are plenty of gaps. I mean, every day almost there's a gap. I mean, when you look at Snap and you go back in here the middle of October, and let me see if maybe this will help.
Yeah, I mean, that November one, you've got...
There are just gaps everywhere. I mean, not even the big ones with heavy volume. I'm talking about here in middle of October, no volume, and there's a gap down.
Mm-hmm.
If I don't have volume, how do I know whether that's a big sell-off or if that's just a normal little, gap down because internet stocks went lower? I mean, I just have no idea. To me, this chart, these huge volume bars stick out to me and mean something. So I know I'm kind of rambling, but I think for me anyway, I would have to say I disagree.
There you are. And I can totally see your point as well. But, as far as watching our trading styles and our analysis styles, I think everybody would have guessed this as far as whether we would agree or disagree, because volume plays a very important part in your analysis. Whereas for me, it's secondary. And somebody actually asked that question, what do you pay attention to more? And, trend model, PMO, that sort of thing. And personally, I mean, I really trust and work mostly with rising trends, trend model signals, and the PMO and what it's doing. I mean, I do put a lot of emphasis on the PMO, and I would say, depending on my trading term, trend models are more important to me in the intermediate to long term, whereas in the PMO is extraordinarily important to me in the short term for my trades. So,
yeah, I think maybe, well, it looks like the audience agreed with you, but from your comment where you said that price is matters, volume matters, but doesn't matter as much, tells me that that volume does matter and that price isn't the only thing that matters.
well, obviously, I mean, I use it, I like to include it, but it's not the determining factor for me. I could go without it if I had to, like desert island, like I could do it. I wouldn't want to, but I could do it.
Okay, little different interpretation, because when I see that only thing that matters, that's where I mean, I agree with you. I think price is obviously very important. I mean, you're buying and selling stocks. When it comes down to how much money you make, you can't say, well, you know what, I lost $1,000 on that trade, but volume was high. I mean, you lost $1,000. It doesn't matter what volume was doing. So in the end, price literally is the only thing that matters. Did you make money or did you lose money?
Well, and the funny thing is, my Chart Watchers article was, why is volume important? So clearly, I mean, I don't write off volume here as far as that. So, and looking at our weekly schedule, it's just going to be great. Tomorrow, Tom, you're going to do that workshop on reasons to sell. I know people can't wait for that. Everything stock charts is going to be on Tuesday. And Mark Young from Wall Street Sentiment Survey is going to be here on Wednesday to talk sentiment. I always do that for you guys on Friday, and it'll be great to have him to give you the other dimension to sentiment and what he looks at. And then Arthur Hill is there on Thursday to come in and talk with us. And then Friday, it's not listed, but the market is closed, so we will not have a show that day.
Yep, we will have Arthur in to close out the quarter. Be a great show and obviously a great week with that lineup. I do want to thank everybody for being with us today. Please remember to complete the survey as you exit. We do love to get your feedback, to hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody, and we'll hopefully see you back here on Friday. Happy trading.